What if I told you that with just $100 and your laptop, you could start building a path toward financial freedom today? Sounds impossible, right? But here's the thing. Even the biggest investors started somewhere. And today, I'm going to show you exactly how to take that first step. Stick around, because I'll not only reveal 5 powerful investment strategies anyone can start with just $100, but I'll also show you the one strategy that delivered mind-blowing results. Ready to transform your $100 into your first step toward financial freedom? Let's go. 5 online investments you can start today. Why start with $100? Now, I know what some of you might be thinking. What's the point of investing such a small amount? Well, here's the truth. Starting small is where most successful investors began. It's not about the amount you start with. It's about building the habit and understanding the process. And $100? It's the perfect amount to test the waters without taking on too much risk. Today, we'll break down 5 strategies using 5 categories: learning curve, passive income potential, tax efficiency, risk level, and real-world results. By the end, you'll know exactly where to put your money for the best outcomes. First up, individual stocks. When you buy shares in a company, you're not just investing money, you're owning a piece of that business. Imagine saying, "I own Apple," or "I'm a part owner of Amazon." But is it worth it for beginners? Let's break it down. Learning curve. Stocks require effort and research. You'll need to study income statements, industry trends, and leadership. Platforms like Robinhood or Trading 212 make it easier, offering demo accounts for practice. Still, it's not a guessing game. Passive income potential. Some stocks pay dividends, which are like little bonus checks for being a shareholder. But with $100, you're not retiring on dividends just yet. Risk level. Stocks are risky. Prices can soar or plummet, and with $100, diversifying or spreading your risk is a challenge. So, how did my $100 do? I spread it across a mix of companies. After 4 years, my portfolio grew to $145.67, thanks to a mix of price growth and dividends. Not bad, but let's see if there's a better option. Pro tip: if you're new to stocks, start with blue-chip companies. These are well-established, reliable businesses that tend to weather market volatility better. For instance, think of companies like Coca-Cola, Microsoft, or Procter & Gamble. These can be a safe introduction to stock investing. And if you really want to play it safe, consider index funds. They're a basket of stocks that automatically gives you diversification and exposure to the broader market. But more on that later. Did you know that even Warren Buffett, one of the greatest investors of all time, recommends index funds for most people? He said they consistently outperform stock-picking strategies over the long term. Strategy 2. REITs. Real estate investment trusts. Want to invest in real estate without buying a house? REITs let you own a slice of properties like malls, apartments, and offices from your laptop. Learning curve. REITs are easier than stocks but require some research. You'll need to check out the properties they own and their past performance. Passive income potential. This is where REITs shine. By law, they're required to pay out 90% of their income as dividends. That means regular payouts for you. Risk level. Medium. Real estate investment trusts are less risky than individual properties since they spread their investments across multiple buildings. But market downturns can still hit hard. My $100 in a REIT earned steady dividends, growing to $110.52 over 4 years. It's a slower, steadier option, perfect for those who value consistency. Here's another perk. REITs often include properties that an average investor could never afford, like massive office complexes or shopping malls. You're essentially joining a team of investors pooling resources to own high-value properties. If you're interested in REITs, look for ones that focus on growth sectors like technology-focused data centers or healthcare properties. These industries have shown resilience and growth even during downturns. For instance, during the 2020 pandemic, some REITs specializing in logistics warehouses, like those used by e-commerce companies, saw significant growth while others struggled. This shows how critical it is to choose the right sector. In many countries, REITs also offer tax benefits. For example, in the US, REITs distribute most of their income without double taxation, which makes them a tax-efficient choice for investors. Bonus tip: if you're looking for a beginner-friendly REIT, check out those focused on residential properties. These tend to be more stable and less affected by market fluctuations than commercial REITs. Cryptocurrency. Now let's dive into crypto, the wild west of investing. With Bitcoin, Ethereum, and dozens of altcoins, the potential for massive returns is huge. But the risks? equally massive. Learning curve. Setting up a wallet and using exchanges like Coinbase is simple, but understanding blockchain and staying updated on trends takes effort. Passive income potential. Crypto doesn't pay dividends, but you can earn through staking or yield farming. Be warned, these methods can be risky. Risk level, very high. Prices can double overnight or drop to zero. Only invest what you're willing to lose. I put $100 into Bitcoin 4 years ago. Today, it's worth $652. Insane growth. But remember, crypto's not for the faint-hearted. Before jumping into crypto, ask yourself, do I understand how it works? Crypto is highly speculative, so make sure you're not just following trends, but actually believing in the technology behind your chosen coin. For beginners, Bitcoin and Ethereum are safer bets compared to smaller altcoins. They're more established and have broader adoption, which makes them less volatile than newer cryptocurrencies. One growing trend in crypto is decentralized finance, or DeFi. Platforms like Uniswap and Aave allow you to lend, borrow, and trade cryptocurrencies without traditional banks. It's an exciting space, but remember, the risks are even higher. Looking ahead, the rise of central bank digital currencies, CBDCs, might impact how cryptocurrencies interact with global economies. While no one knows for sure, it's clear that crypto is here to stay, but with high stakes. If you invest in crypto, prioritize security, use hardware wallets, and enable two-factor authentication on your accounts. A little caution can save you from losing everything. Diversify even within crypto. Holding both Bitcoin and Ethereum reduces the risk of putting all your eggs in one basket. Strategy 4. Gold. Gold is one of the oldest forms of wealth. But can this ancient asset compete with modern investments? Learning curve, low. You can buy gold ETFs or physical gold like coins. It's straightforward. Passive income potential, none. Gold doesn't generate income. It's a store of value. Risk level, medium. Gold holds its value well during economic downturns but won't grow like stocks or crypto. My $100 investment in gold grew to $140.10. It's reliable, but growth is limited. Fun fact. Gold has been a go-to safe haven for centuries. From the Roman Empire to today, gold has been used to protect wealth during uncertain times. That's a level of trust most assets can't claim. If physical gold storage feels like a hassle, consider gold ETFs. They're easier to trade and don't require a safe to store your investment. Did you know gold is also used in technology? From smartphones to medical devices, gold plays a critical role in modern tech, making it more than just a shiny metal. Recently, central banks around the world have been increasing their gold reserves. This trend signals a long-term belief in gold's stability and value as a global asset. Gold is also inflation-proof. When the value of currency drops, gold often holds its value, making it a hedge against inflation. Index funds. If you want steady growth without constant monitoring, index funds are the way to go. Learning curve, low. Index funds track markets like the S&P 500, so there's no need to pick stocks. Passive income potential. Dividends from the companies in the fund can be reinvested, compounding your returns. Risk level, low. Diversification across hundreds of stocks makes this a stable option. My $100 in an S&P 500 index fund grew to $179.57. Nearly 80% growth with minimal effort. Here's why I love index funds. They're like the ultimate team player. Instead of betting on one superstar stock, you're betting on the entire team. Historically, this strategy has consistently delivered. Look for low-fee index funds. Over time, high fees can eat into your returns, so choosing funds with minimal management costs will make a big difference. While index funds might seem slow compared to crypto, their stability and reliability make them ideal for long-term wealth building. They're a cornerstone for any balanced portfolio. If you're looking for international exposure, consider global index funds. These offer diversification not only across industries but also across countries, giving you a stake in the global economy. For example, John Bogle, the founder of Vanguard, revolutionized investing by creating the first index fund. His vision was to help everyday investors achieve consistent returns without the high costs of active management. So, which strategy wins? It depends on your goals. Crypto delivered the highest returns, but it's also the riskiest. Index funds are perfect for consistent long-term growth, while REITs offer stable passive income. The key is to diversify and choose a strategy that aligns with your goals and risk tolerance. If this video inspired you to start investing, Hit the like button and subscribe for more tips to grow your wealth. Want to know 7 best side hustles to start in 2025 for extra income? Check out this video next. See you there.